Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about 4 ways to pay off your mortgage faster. Now, for a lot of you, you're going to say, well, Adam, why would I want to pay off my mortgage faster when I have a 1.5 to 2.5% interest rate? Why wouldn't I put my money into an RSP or a tax-free savings account and grow it at, say, 5, 6, 7%? You know, that spread, that's a nice spread. I can earn extra money. And I totally agree with you. And honestly, that's my personal opinion. But a lot of you want to pay off your mortgage faster. It's a personal preference. It's a goal thing. You may want to be mortgage free by retirement. I have a lot of family friends and we have clients that definitely want to pay off their mortgage before and make it a primary goal of theirs versus, building up a huge RSP or TFSA, whatever it may be. So today I just want to go through, if your primary goals or one of your financial goals is to pay off your mortgage, I want to give you 4 tips to kind of help you do that. And I want to kind of highlight the amount of interest you pay on your mortgage, how to reduce that. And again, just little changes that you can make that will drastically reduce the interest you're going to pay in your mortgage and also reduce the time you have your mortgage in your lifetime. So as you're probably aware, if you hold a mortgage, you understand that early on in a mortgage, when you make a payment, more than 50% of that payment goes to interest payments. The rest of it goes to your principal payments. Okay, so that you need to understand. So if you jump online on a mortgage calculator, you'll see that it's a curved graph. Okay, so early on, let's say on $1,000 of your payment, 40% of that will go to your principal, but the rest is going to interest. So it's very interest heavy payments early on. Now, as you get later on in your mortgage, of course, you're going to pay a lot less interest, more principal, and eventually pay off the whole thing altogether. So you need to be aware of that, okay? So it's not a flat line 50-50 or whatever it may be. It is a curved graph that you're definitely paying more interest early. So, the quicker you can pay it down, the less interest you're going to pay. And we'll go through that here in a minute. For the purpose of this video, the example we're going to use is a $500,000 mortgage. 4% interest rate and amortized over 30 years, okay? I understand a lot of you don't have a $500,000 mortgage. I understand a lot of you have much less. We come into mortgages much higher than that as well. It is kind of the average, especially in the Vancouver, Toronto areas. If you live in a smaller area or lower cost area of Canada or across the world, I get it, your mortgage may not be that high. But for this video, we're going to do a $500,000 mortgage, 4% interest rate. And why we did 4%, not the current 2% that you can get on the market, I think that's going to be more average over the next, say, 25, 30 years of the time that you're going to carry your mortgage. So just some quick facts about that mortgage. Your monthly mortgage payment is going to be $2,377. The amount of interest you're going to pay over the 5-year term is $94,000. The amount of principal you're going to pay is $48,000. So as you can see, a much larger amount of interest and actual principal paying down. Now, if you roll this whole mortgage out for the whole 30-year amortization and just flat paid it over that period, you're going to pay a total interest of just shy of $356,000. So on your $500,000 mortgage, you're paying about $356,000 of interest on top of that. So as you can see, if interest rates go higher, you could probably pay as much interest over the term as your original mortgage would have been. Okay, so the first way to pay off your mortgage a little bit faster would be to do accelerated weekly payments. Now, accelerated payments means you're paying a little bit more than you would otherwise. But in this scenario, we're looking at just a small amount of money extra every week. So moving from a monthly payment to a weekly payment and just bumping up that payment to the accelerated rate, which in this case jumps to $594. So if you do a regular payment, it would be $548. So it's an extra $46 every week that you're going to pay. So not a huge amount of money. I get it. It may not fit in all your budgets, but if your goal is to pay down your mortgage, if you can find that extra $46 in your budget every single week, it's going to be drastic change. So over the 30-year term of that mortgage, you're going to save over $55,000 in interest costs. Okay. So, again, a small amount of price to pay to get a huge benefit, over $55,000. And you're going to pay off your mortgage a lot quicker. So again, you're going to save over $55,000 in interest, and your mortgage is going to be paid off 4 years earlier. Okay, so accelerated weekly payments can really help. Again, accelerate, just pay off that mortgage and avoid a lot of that interest costs, both early on and later on. So when you make an accelerated payment, The additional payment, like any additional payment on your mortgage, it pays off kind of the end of your mortgage, which has more principal payment than interest payment. Okay, so be aware of that. So if you can afford the accelerated weekly payment on your current mortgage, take a look at that and run the numbers to see how much money you're going to save both in interest and how much faster you can pay off your mortgage. The second way to pay off your mortgage faster is to do an additional lump sum on your mortgage every single month. So again, option one was an accelerated weekly payment. So you just change your payment plan, bump it up a bit, but it's a weekly payment, okay? Option two is to stay on that monthly payment plan that you would otherwise, but you're going to contribute an extra $250 every single month onto your mortgage, okay? So just a small lump sum, not a huge amount of money, but just a little bit every single month, just drip away at that. The savings is drastic. You're going to save over $68,000 in interest payments by doing that. You're also going to cut the time of your mortgage by 5 years. So if you've amortized it over 30, the reality is it's going to be paid off after 25 years. So again, $250 may not be in everyone's budget, but if you're saving money and your primary goal in your savings is to pay off your mortgage, hopefully you can find that $250. It might be $200, it might be $500. You're going to save more money then. But look at an option to pay off your mortgage a bit faster just by a small amount of monthly payment on top of your regular mortgage payment. Now, before I jump into number three, I do want to say we've included a few calculators below. One that I really like, Dave Ramsey put together. So make sure you check that link out below. It just shows you if you make, extra payments, whether it's, weekly, bi-weekly, monthly, annually, one time, whatever it is, it'll show you how much money you're going to save in interest, how much faster you can pay down your mortgage. So check that calculator out below. And if you aren't subscribed to the channel and you're watching these videos, make sure to hit the subscribe button. It takes you 1 second. It costs you nothing, and we really do appreciate you joining our channel. The third way to pay off your mortgage faster, and I really like this one, and this probably falls within most people's kind of budget and category. A lot of you might get a big tax refund or a bonus at your job or whatever it may be. There may be a bit of a lump sum coming to you on an annual basis. So the third option to pay down your mortgage faster is to do a one-time annual lump sum payment on your mortgage. So instead of doing it say monthly or even weekly, we're looking at just a one-time annual lump sum. So on this same mortgage, again, $500,000, 4% interest rate amortized over 30 years. If you took your $5,000 tax return or bonus at work and threw it down on your mortgage, it's going to save drastically. So it's going to cut your mortgage by 7 years, just over 7 years. It's going to save you in interest costs of $95,000. So a huge amount of money. Okay, it's saving you $95,000 in interest. It's cutting your mortgage down to 23 years from 30. That's almost a 24% decrease in time that it takes to pay your mortgage off. Okay, so that's a huge benefit, obviously. So I know a lot of you, again, watching, not everyone gets a $5,000 bonus or a big tax refund. But if you come across a bit of money and you're not sure what to do with it, and one of your primary goals is to pay off your mortgage, consider putting a lump sum on your mortgage, because it can make a huge difference, both short and long term, just reducing the amount of interest and paying your mortgage off earlier. The fourth way to pay off your mortgage faster, and I think this is the most important one, and this is the biggest trap that people fall into, whether you're in Canada, the US, anywhere in the world, is not changing the amortization on your mortgage when you renew. Okay, so what I mean by that is, again, we're looking at a 30-year amortization, a $500,000 mortgage, and 4% interest rate. Your payment is $2,377 a month, okay? Now, fast forward 5 years. You've paid that mortgage for 5 years and you come up for renewal. What do you do? Well, I can tell you this. Most of you watching this video renew on a 5-year term, 30-year amortization, and your payment comes down. Now, your payment goes from $2,377 to $2,149. So what do you do with that extra few $100s? Well, it's probably being spent elsewhere, okay? And now you've amortized over 30 years again, okay? Most people don't understand this, and I don't know why, but if you keep amortizing over 30 years, you're never going to get rid of your mortgage, okay? And I would say 8 out of 10 people do this, okay? It's very common. People, maybe interest rates increase a little bit. So it's, hey, to keep our payments the same, we need to amortize over 30 years again, okay? Which, sure, I get it. To keep your budget the same, keep the payment roughly the same, that may be the case for you. And I think going forward, interest rates will probably creep up. So if you're on a 30-year amortization right now, and your payment is, $2,400 a month, and rates go up a bit, be aware your payments are going to go up. but make sure you amortize over 25 years. After 5 years, 20 years, okay? It sounds like a simple concept, but too many people don't do it. Okay, there's other ways to do this as well that work really well. You can do the 30-year amortization again, but make payments as if it was a 25-year amortization. Okay, so that can be a good strategy too, and that kind of falls into option 1, 2, or 3 as far as making additional payments. So if you amortize over 30 years again, your payment's $21.49. It's much less, but you're taking that extra $200 to $300 every single month and doing lump sums on your mortgage. Okay, that's going to work very well as well. So there's different ways to cut it, but for most of you watching these videos, you need to take a hard line on this. The first mortgage you get on your house is amortized over 30 years. Then you're at 25. Then you're at 20, 15, 10, 5, mortgage free. You need to follow that process, or you're going to run into big trouble and you're going to run into a large size mortgage when you hit retirement. Okay, so again, most of our clients are kind of at 55 plus, entering into retirement that we work with and we put plans together for. And a lot of that is people have saved and worked hard and they know they've done well, but they don't know what to do next. And that's where they come to us and we build out a financial plan for them. We're happy to do that. But we do know that, just talking to so many of you, that you have a small mortgage creeping up to retirement and you want to get rid of it. Okay, not many of you want to carry a mortgage into retirement. Now, the reality is probably a lot of you are going to have to carry a mortgage into retirement, because if you haven't followed this plan to reduce the amortization over the years and you're in your late 50s, it's a little too late to do that. So again, there's some other strategies we can look at within your plan, depending on where your cash is, investments and all that. We can look to try and hammer down that mortgage faster if it makes sense within your plan. But if you're watching this video, or maybe you're in that stage, 50, 60-year-old, you have kids or grandkids, encourage them, educate them, pass this video on to them so that they can understand that, look, you need to pay over 30 years, then 25, then 20, then 50. You need to reduce that amortization or keep the amortization the same, but then make sure you do those lump sum payments to make sure that you follow the same schedule that you would otherwise, okay? So very important. Or else you'll get in the trap of, hey, I got more money, my mortgage payments are less, I can go travel, I can spend it on this, that, the other thing. And at the end of the day, all that's doing is bringing your mortgage into retirement, which ideally you don't want. Before we end this video, I just want to give you one more kind of bonus tip here on how to pay your mortgage off faster. And it's more a tip to, not, drag on your mortgage forever. And it's around when you're up for renewal. A lot of you, especially with real estate prices the way they've gone, unless you live in Calgary, your house has gone up in value in the last, 2 to 5 years. So a lot of you are saying, hey, look, I've made, 2, 3, 500,000 or $1 million on your house. I'm going to do a reno. I'm going to pull a bunch of that equity out and do a reno. I've made money. Like, that makes sense. But remember, when you pull that money out, that is additional mortgage. That's additional debt that you need to pay. So before you just jump into it and say, look, I've made 500,000, I'm going to take just half of that and do a really nice reno on the house, and it's going to be much nicer to live in, and it's basically free money because it was market gain. You still have to pay that back, or you have to downsize. But remember, if you're going to downsize, you're downsizing in a market that has also gone up. Okay, so it's not going to be the full gain there as well. If you're taking on additional mortgage to do a renovation, just make sure it fits into your plan, right? Don't set yourself back 10 years in retirement by doing, a reno to your kitchen that is already okay. That doesn't make sense. So make sure you don't jump into a huge, reno when your mortgage comes due. A lot of people, we see it a lot. Mortgage comes due, value of your home is increased. You take it out to do a reno, to do a trip, to buy a new car, which is even worse because it's a depreciating asset. So if you're in that situation, just make sure before you take more money onto your mortgage that you can actually afford it and actually fits into your plan, and that it doesn't force you to carry that mortgage into retirement if it wouldn't have otherwise. So, sit down with a financial planner, just run the numbers on your end, make sure that it lines up with your goals, with your objectives, and make sure it doesn't set you back for retirement. So thanks for joining us in this video today. Again, there's so many ways to pay off your mortgage faster, whether it's just an ongoing monthly payment, the accelerated weekly payment, lump sums on a monthly basis, on an annual basis, whatever works for you, wherever kind of your cash flow comes from, whatever fits into your budget, find a way to pay off that mortgage faster if that's a goal of yours. Again, for me, I just pay that regular monthly payment. I prefer to put my money in investments. I think, I'd rather borrow money at 2% and get a 5 or 6% rate of return. I like that spread. But again, I have 2 brothers, both of them, their goals are to pay off their mortgage, which is great. We have a lot of friends, we have a lot of clients that's their goals as well. So, take a step back, look at your financial goals. If paying off your mortgage is one of them, high on the priority list, then follow one of these 4 strategies. And again, make sure you decrease that amortization over time to don't fall into the trap of having free cash flow that you're spending elsewhere. So thanks for joining us in this video. We'll see you in the next one.